Well, we've got a lot of attendees in here today, and I think that probably what everyone signed on to hear today was tell me exactly the correct day for me to retire.
Yeah.
And unfortunately, there's not always the perfect answer, but I will say that we've seen a lot over our careers as far as the things that people tend to talk about with the reason why they retire. So I've heard, hey, I've got this huge project. I've been working on it for a couple of years, and I just want to see it to the end. And once I get to the end, I'm going to retire. Or for others, they're really into being debt free. So they say, well, I'm just going to pay off my mortgage. And once that's paid off, sometimes it's just, family stuff. I moved to a new house, or I want to move closer to my grandkids. We hear that a lot. Or my first grandkid was born and I really want to spend more time with my family. For some, the younger people tend to be thinking about a certain age. I want to make sure I'm retired by the time I'm 55 or 60, 65, whatever the number is. And then there's always your favorite one, Nick, right? Which is
exactly.
Nick had to add that one in for everybody. He wanted to make sure that he knew exactly when golf season starts. I don't even know when it starts. When does it start?
That's a trick question. Every day is golf season.
Yeah. So it's just, for a lot of people, it's just around keeping up with, their hobbies, what they've got going on in their life. And so those are kind of the non-financial reasons. But I think today, because we're a financial planning firm, we wanted to spend a little time talking about the financial things that people need to think about. So
yeah, exactly. And those are all great reasons. But, we're going to focus on financial considerations when, contemplating retirement. And I think maybe the most important question is, can you afford to retire? Because you can want to retire or you want to, but if you can't afford it, there's not really a decision that has to be made. And then, next, what are some things that you should take advantage of at the end or near the end of your career? That could be 401k deferrals, life insurance, vesting requirements, and we'll go through more throughout the slideshow. And then, lastly, coordination with Social Security and pension dates is a huge consideration that we're going to discuss later as well. I just kind of wanted to highlight those before we get into, digging deeper into the financial considerations. So everyone has a 401k. Most people have 401k at work, or they at least know what one is. So, Aaron, why is it important to make, use 401k deferrals nearing retirement or at retirement? Because why does it matter you're retiring?
Yeah. So, I kind of always think of it in terms of 401k is kind of your last opportunity to save that last bit of money into your account. And so really the last couple years, we hope that everyone is maximizing the amount they put into their 401k. And if you think about it, if somebody's retiring in, say, December, it doesn't really matter. You have the whole year, the whole calendar year to get the $19,500 or the $26,000 into that 401k plan. But let's say you're retiring, say, July 1st. Well, now you only have half a year. So if you've only got half a year, really what we want to see people try to do is maximize that amount, that 26,000 or so, over those 6 months. And everybody always says to me, good grief, now if I do that, then I'm driving my paycheck down to nothing. And that's the truth. Sometimes you really are. But I feel like it's important because it's that last bit of tax deferral that you have. It's the last bit to take advantage of your company match. And so you just want to try to maximize that final year that you're working. And for some people, they're not sure. They say, oh, well, I might retire this year. I might retire next year. And I've seen people do that before where they max it out for 1 year by April or May, and then they're like, I decided not to retire. Well, it's no harm to that. But really just thinking about that final calendar year, make sure that you maximize your 401k that final year.
Yeah, and those are great points, and, kind of going in that same direction, looking at the tax impact of deferred compensation plans. Well, first, what is a deferred comp plan, that maybe if everyone, is not familiar with one?
Yeah, so deferred compensation is different from a 401k plan. So this is usually, we see this with people who are maybe in their high income earning years or executives. They want to defer maybe part of a bonus or part of their ongoing compensation into a plan. And it does get a tax deferral status. In other words, if I decide, hey, I'm going to put $30,000 this year into my deferred comp plan, you don't pay taxes on it that year. You push the taxes out. However, usually when you sign up for these plans, say when you're 40 even, you're basically deciding at that moment, hey, this is going to be my payout for this plan. And when it's paid out, you're going to have to pay income taxes on it. It's a great option for people in the highest income earning brackets to defer taxes to years where they think their income taxes will be lower. The only issue is that because you're deciding a long time ago when to pay it out, you don't have a lot of choice. And so I've seen it a lot where people say, oh, we're going to take it within 6 months of retirement, or over 5 years starting at the retirement date, or over 10 years starting at the retirement date, or they could say, a year after retirement. You're usually picking that way earlier. And so when we think about this, it makes a huge difference when we're talking about a retirement date, because if you have deferred comp, you have to keep in mind that these payouts are going to happen. You've already chosen them to happen. And so you're just kind of wanting to make sure that you're taking advantage of the payouts in the years when your income tax is the absolute lowest.
Yeah, and that's a good point that, sometimes it may not matter the exact date on some of the things we're talking about, but this is a situation where it may depend on the actual date of the month. And so we talk about 401ks, deferred comp, and then now we're kind of going to go to Roth IRAs. And, some people may say, why is this, necessary? I'm about to retire. I thought that was for, people earlier who are not making as much, but, we want to work long enough to be Roth IRA eligible, and Aaron will explain that in a few minutes. But first, just a refresh on what Roth IRAs are. They're an after-tax account. Once the money goes in, it's really never ever taxed again, and that's a huge benefit in retirement and really in life. And Aaron, if you kind of want to follow up on that of why should you work long enough to be Roth IRA eligible? What does that mean?
This is kind of a misnomer, really, because everyone's kind of Roth IRA eligible in that they can contribute to it as long as they have earnings. So they have earnings at work. But to your point, Nick, there are income phase out rules. And so what we see is our people who are earning the most money actually don't have the eligibility to contribute to Roth because their income is just too high. And so I talked earlier about that 401k, you work half a year. Well, now if you only work half a year, then suddenly you're looking at a situation where you made half as much money. And so maybe your income is such that you would qualify to contribute directly to a Roth IRA. And so taking advantage of it in that final year or final couple of years, some people may pull back at work. They may say, hey, I work, 60 hours a week. I'm going to work 25 hours a week, or I'm going to take a consulting gig that's paying me a little bit less, or whatever it is. Those years where you're earning less, that's when we should be taking advantage of the Roth, even if you're nearing retirement. And so as a reminder, we put on the screen how much you can contribute. It's not a whole lot, but $6,000 or $7,000 a year can add up, even if it's only a couple of years, especially if you think about it's invested and growing, hopefully. So it's one of these things that as long as you're working, you should be thinking about a Roth, especially in the years where your income is less than what it's been previously.
Yeah, I agree, because typically a Roth IRA is something that we, pull from or look at last, in respect to every other account. And so if we get that last little bit in there, that $6,000, $7,000 can go a long way. If you retire 50, 60 years old, that can go a long ways. And so next, we're going to go through vesting requirements for employer provided benefits. And again, vesting can mean a lot of different things. But Aaron, if you could walk us through, give us a refresher on what vesting means in this circumstance.
Yeah, hopefully everybody knows kind of what vesting is, and that's a term that they've kind of been told about early on in their career. A lot of times you have vesting requirements on types of 401k plans. So sometimes we see it on like a 401k match, not as much anymore. Usually with 401ks, you're automatically vested in what you contribute, but a match sometimes might have a vesting requirement on it. And that's how long you stay at the company. Are you there long enough to actually receive the benefits? Same thing with profit sharing. We see that quite a bit, where there's some kind of, you have to be here 5 years to get the full profit sharing that the company's contributing on your behalf. We definitely see it a lot with pension and stock compensation plans. So obviously pensions are usually not just, have you been here long enough, but also usually we're getting to a certain age, which we might talk about in a minute. But stock is a big one. I see this quite a bit. I see where, and I think these companies have gotten pretty smart about this. They say, you know, here, we're going to give you this restricted stock or stock option, and you're going to vest in it over a couple years. And you really have to be there for 2, 3, 4, 5, maybe even 10 years to get the full benefit of those stock plans. And so I always have this conversation with clients. It's like, well, gosh, if I leave now, I'm leaving all this money on the table as far as my stock. And so you kind of have to pick a sweet spot, and sometimes we have to walk away from some stock at the end. But just kind of making sure that you understand exactly what your company's vesting requirements are, making sure that you have all your ducks in a row as far as these plans, that you receive the full benefit of everything that you are entitled to.
Yeah, and that's a good point, again, to be aware of the exact day that you retire. It's not, I'm going to close my eyes and then just pick on a calendar what day, you know, I want to retire. It's kind of, you know, let's be strategic and think about this. And like, you know, really retiring a day early could mean losing out on a lot of money if you're not careful.
Yeah, and the restricted stock, this is one that you literally vest on a day of the year usually. And so it's like, you know, February 12th. And so you don't want to obviously retire February 10th and walk away. Most people are fairly aware of this, but it is something to just kind of pay attention to.
Yeah, exactly. And so kind of a continuation, you know, of that slide, we talked about vesting requirements. Now, what are some benefits that you're eligible to take with you, maybe some that aren't when you retire? And why would you even need to take benefits with you when you retire at all? Like, you're retired, you're not working, why do we still need these benefits?
Yeah, I mean, obviously the pension one is straightforward.
Yeah.
You know, usually it's a number of years with the company, age and stuff. We don't see pensions as often for people anymore, but obviously it's always a consideration. The one that I'm seeing maybe more for some types of companies, say government and so forth, are the health insurance and also the life insurance and long-term care. And so a lot of companies do offer some type of health insurance coverage for their retirees. And so just making sure that you're eligible for those, or understanding that when I quit my job, I may have to pay for my own health insurance and what the cost differential is. We have that question quite a bit from people. How much am I going to end up paying if I don't have my company, you know, insurance anymore? The other one is the life insurance. Sometimes companies allow you to take that life insurance with you to give coverage, help for your family. Sometimes they don't, but sometimes you don't need it. You know, sometimes we look at life insurance and we're kind of like, oh, well, you're at the point now where we really don't need to see, you know, life insurance on your balance sheet anymore. Another one, honestly, this one I'm seeing more and more is long-term care insurance. If they're offering that through work, typically it's going to be portable, meaning that once you leave employment, you're able to take that benefit with you and continue to pay the premiums yourself. And so just making sure that you know what those benefits are, what you're going to have to replace in retirement, but also understanding that making sure that when you do quit your job, that you're making sure that all the things that are portable continue on with you.
Yeah, and that's a good point as well, especially with life insurance, is that when you quit or retire, you may need life insurance after you retire, and then to kind of figure out how much you need and to kind of correlate, you know, with that is also a good point. And so, you know, we had already kind of talked about pensions earlier, but on this slide, we're going to go over some questions that we ask clients, ask clients to think about when considering pensions, you know, in regards to retirement.
Yeah, and again, pensions are not something we're seeing all the time anymore, but it's something that's a huge benefit for the people that do have them. And so the first thing we think about is, you know, should you take your pension as a pension, so an income stream that comes in every month, or should you take it as a lump sum? And usually when we talk about a lump sum, we're talking about a rollover from the pension account into your IRA. So that's a tax-free transaction. And then you just take distributions as you go. So we run all the time analysis that think about, you know, pension versus lump sum and what the best option is. And a lot of it is rate of return. You know, how long will it take? If I take that as a monthly amount, how long does it take me to break even on the lump sum? How long does it, you know, how long until you get a certain rate of return? And so that's kind of what we look at. The big question is if you do need your pension to start right away in order to pay for your expenses. So a lot of people want to go ahead and start their pension. They feel like, well, it's sitting there. And so, but some other people are like, no, I don't really need it. I've got other income sources. And so they may not need to start it right away. And if you can defer it, sometimes that amount can go up for each month. And for my early retirees, it's always, can you afford to retire early, take less of a pension benefit? So that's always a question mark. And then the big thing for our married clients is, thinking about, well, I have a benefit. Do I need to continue it if something happens to me? And so that's really a question around, joint survivorship, or should you instead have a life insurance policy that covers your spouse in case something happens to you? And there's all kinds of questions around that. And so to me, these are huge decisions, and they're typically irrevocable decisions. And so once you opt into a pension, you're kind of opting in for life. And so you really need to make sure that you're weighing all these decisions correctly.
Yeah, and those are all great points. And so are there any non-financial considerations when evaluating pensions?
Yeah, I mean, there always are. So what I just talked about are the financial questions, right? But the non-financials would be, do I have a health care, do I have a health crisis in my own life where it makes sense? So if I've just gotten a diagnosis, sometimes it might make sense to take a lump sum so that my family's covered in case something happens to me. We see that, sometimes happening. And so you just want to make sure that you're thinking about all those other people in your life and your own situation, because sometimes the financial, I always tell people it's the sleep test, right? What's going to help you sleep at night? And sometimes those are non-financial considerations.
Yeah, and that's, a great add-on there. And so, our next slide is maybe, one of the most maybe asked about questions, or, questions people ask the most often is, when should I start Social Security? Should it be the day after I retire? Should it be 3 years, 4 years, the max date? And, I guess could you kind of give some insight on how we think about that?
Yeah, this is the one, honestly, that everyone asks, and they ask it over and over and over again. And it's funny to me. So clients that are on the webinar today are going to laugh and maybe remember me saying this. It doesn't really move the needle all as much as you would think it does. But I think we all have in our thoughts that, hey, I've been contributing to the Social Security system for years. I mean, since I started my first paycheck, and I kind of want to get my benefit at some point. And so there always is this extra emphasis on it. For us, I think we think about both the cash flow and the taxes. So the cash flow is, can I afford to live off other things? Do I have a pension? Do I have an IRA? Do I have other accounts that I can live on and defer Social Security? Because the best part about Social Security is that you get not only the cost of living adjustment that, the IRS gives us every single year, but you also get a bump. And so, prior to between full retirement age and age 70, you get an 8% bump every single year. And so if you can keep Social Security kind of in your back pocket to start later, and you live off other things, then that can be a real benefit. And so that's cash flow. But then you've also got the tax considerations. Social Security is taxable, not 100%, but up to 85%. And so it's just something we have to keep in mind as we start the spigot on the benefit.
Yeah, no, that's a good point as well, because I think a lot of people, and myself included, when I started in the industry, it's like, Social Security's tax. I thought we already taxed on that. I thought that was taken out of our tax. I didn't think we'd be taxed on it again. But that's kind of, like you said, we are taxing that to a certain extent. And, kind of moving towards the end here, Erin and I have a few kind of points we wanted to close out and say before we finished off here.
I mean, I think the point of this webinar was not to answer specifically for each person listening that exactly what their retirement date needs to be, but it was more that we wanted to make sure that you understood that there's a lot of questions out there, and that everyone's questions are kind of customized to their situation. And so there's no way we could come on here and go, rule of thumb, 65, that's when you should retire. We want to make sure that everyone's plan is looked at, and that you look at your personal situation and all your benefits and all your accounts and all your different decisions you need to make. And we customize that to you and make sure that that you feel good about retiring.
Yeah, exactly. I think that's an important, point is that it depends, right? It depends on when you want to retire, when you can afford to retire, and a lot of that depends. And with that, this is a big decision that's irrevocable and life altering. I don't know how many bosses, I quit, I retire, I go home for 2 months, and I come back to the office. Hey, just kidding. I want my job back. I don't think that's super realistic for a lot of people. And so there is a lot of thought that should go into this decision. It shouldn't just kind of be like on a whim, I guess I'm going to retire on this date. Guess I hope that's what we get. What you get out of this webinar is that it depends, and that there should be a lot of thought and considerations when evaluating that.
Yeah, and that's exactly right, Nick. And the other thing that people always want to hear is, how much do I need to retire? And that's something that honestly, I didn't even think about including, because for every person it's different. It depends on how much money you spend. It depends on how many of your, other income benefits like pension and Social Security you have. And so there's not really a number. Each person's number is a little bit different. And so it's one of those things that we didn't put in the slides because it just doesn't matter. But at the end of the day, I think what we wanted to kind of put across was that everyone needs a plan, and that evaluating all the different options, things that are going on in your life, are the things that give you the peace of mind. And that's what we find that our clients want from us, which is, hey, make me feel good about walking into work tomorrow and quitting and make me know that it's going to be okay no matter what, if that we're going to quit and that it'll be fine and that we've got a plan going forward. And so that's what we want to provide.
Yeah, exactly. And so we did have a few questions come in. If anyone has any other questions, feel free to add to these. But first one is, how soon should I start planning for retirement?
Oh yeah, that's a good one. So a lot of people ask that question. How, should I start when I'm 50? Should I start when I'm a certain age? And we typically see most people will start really hammering into the question about 3 to 5 years from their kind of optimal retirement date is kind of when they start really honing in on some of these things. So I think that would be my answer to that question, somewhere in the 5-year range. I think the people who are younger and are listening now, if you start earlier, then you're probably, what I find is with the younger people is that sometimes you tell them way earlier, like, hey, you actually don't even need to work anymore. And now you're just going to work because you want to, not because you have to. So that sometimes is an empowering thought as well.
Yeah, exactly. That's a great answer. And then lastly, what if tax rates go up? Should I still retire? And I think tax rates are a huge buzzword right now. We've received a lot of questions, and there's tons of articles, news cycles, everything being written on tax rates. So should this be a consideration on retirement as well?
Yeah, I mean, to us, taxes are always a consideration. So we're always thinking about, whether or not, taxes are going to go up or taxes are going to go down. I mean, I will say that for the most part, we're going to plan around what we know now. And we're hoping that, we can, even if tax rates do go up, that it shouldn't impact your total retirement. I'm not going to see it go from, 100% probability of success to 0% just because of a tax rate change. And so I'm not as concerned about that part on changing retirement dates. So.
Gotcha. Okay. And then we just had another question come in. If considering a job change late in life, are there advantages to retiring from an old company versus resigning?
Well, that depends on what the benefits are, right? So if the benefits of the old company of retiring, so that's really the question. If you were going to receive a pension or something like that, and there were benefits that you were going to automatically start, then you kind of have to weigh the tax benefits or the tax question of, if I retire and start a pension, I've got kind of taxable income coming in, and then I go to a new job, then you may be being taxed on it a lot. Or can you defer some of that retirement until later and just move on to a different job? I mean, I never want people to walk away from benefits, but sometimes just kind of stepping away from it temporarily, if that's an option, it can be a good thing. So obviously, it just depends on the situation, probably.
Gotcha. Okay. All great questions. Thank you very much. And so we do have a few, some closing announcements. We do have a few upcoming webinars. The first one is November 3rd, charitable gifting webinar. We, again, received a lot of questions about charitable giving and, kind of strategies around that. And then last one of the year would be December 6th, end of the year tax planning webinar, which super, I think, going to be beneficial, especially Aaron, you can maybe chime in with all the tax law. I think Aaron's on 4 webinars a week with IRS.
Yeah, it's going to be one. I'm hoping that we're going to have some resolve on some things for this year. So that's why we kind of pushed it into December. But November, December is the time of year when we're constantly doing tax planning anyway. So it'll be a good time to give an overview, especially if we have new information. So.
Yep, and we sent out a newsletter with these links on there, and we'll send more out in the coming weeks. But you can always just email us at bfs@beaconfinancialstrategies.com if you have any questions about these. And then lastly, plug for our podcast. It goes out every other Wednesday, Finance in a Flash. We're actually putting one out later today. So look out for that. It's on iTunes, Spotify, Google Podcasts, pretty much anywhere you want to listen to it.
And it's on our website. It's on our website.
Yeah, on our website too, exactly. So you can't, if you miss it, I think that's a you problem. But anyways, thanks everybody for listening, watching along. And Aaron, if you have any closing thoughts, I think that'll wrap it up.
Yeah, I mean, I think overall, I would just tell everyone to think through their own retirement, reach out to us individually. We're happy to always answer questions, and this has been fun.
Yep, awesome. Thanks, everybody.
Thank you.